Can you avoid dilution with venture capital investment? Imagine pouring your heart into your business, only to see your ownership shrink with each new funding round. That's what dilution can do. Venture capital funding often involves issuing new shares, which means your percentage of ownership drops. It's almost impossible to avoid dilution completely because giving away equity is part of the deal. But there are ways to manage or reduce how much you lose. First, you want to negotiate a higher valuation before accepting investment. If your company is valued at $1 million and you raise $100,000, you give away 10%. But if you can push the valuation to $2 million, that same $100,000 only costs 5% ownership. To do this, you need to show strong financial metrics and a solid business plan. Next, be cautious with convertible securities like simple agreements for future equity or convertible notes. These can cause unexpected dilution when they convert into shares later on. Limiting their use or setting clear terms helps control this risk. Managing your employee stock option pool is also key. If you expand the pool before funding, it can dilute existing shareholders. Negotiating to create or expand the pool after funding rounds, known as post-money, can help keep your ownership percentage higher. Securing pro-rata rights is another strategy. These rights let you buy more shares in future rounds to maintain your ownership percentage. If you have these rights, you can participate in later funding to avoid losing ground. Considering non-equity options like revenue-based financing, venture debt, or grants can also help. These methods provide capital without giving away ownership, though they may come with repayment obligations. Planning your fundraising in multiple rounds at increasing valuations can also limit dilution. Instead of raising a large sum at a low valuation, smaller amounts at higher valuations keep your ownership more intact. Anti-dilution provisions are clauses that protect investors if the company's value drops. Negotiating balanced anti-dilution terms can prevent excessive dilution during down rounds. For Asian American-owned businesses, protecting ownership is especially important. It helps preserve the business's cultural values and long-term vision. Understanding these strategies and negotiating well with venture capitalists can make a big difference. Combining strong valuation negotiations, careful management of securities, and exploring alternative funding options can help you keep more control. Consulting with financial advisors experienced in venture capital can also guide you through these decisions. While complete avoidance of dilution is tough, smart planning can minimize its impact and keep your business on a steady growth path.